Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JESSEDAY to get a $10 discount on your first purchase. Today's guest is the portfolio manager at Tidal Financial Group and the publisher of the Lead Lag Report, Michael Gayed. It's great to have you on the show.
One of the many portfolio managers at Tidal Financial Group. I have to say, it's funny. People I don't think really understand what a portfolio manager role is. It sounds like they're just gunslingers going on a particular strategy, but no, it's meant to just do exactly what it sounds like. You're managing a portfolio based on whatever mandate that you're supposed to follow. But I appreciate the invite.
Yeah, I appreciate you being here. And as you're a first-time guest on the show, we always start with the origin story. So how did you first discover investing, and how did that lead you to becoming a portfolio manager and founding the Lead Lag Report?
Yeah, so I pretty much grew up in the business. My father had worked with Bob Farrell in the late 1980s, who was a sort of legendary technician when it comes to investing in markets. Started his own investment advisory firm in the early 90s, got to about $1 billion in assets, launched a hedge fund. He had some notable clients like Stanley Druckenmiller was one of his clients in his hedge fund. And I pretty much grew up seeing all that, right, at a very young age, being exposed to the market, to the business side of investing, which is a whole nother dynamic, which unless you're in the business, you can't really fully appreciate. It's more than just managing a portfolio, or it's more than just what stocks are doing and bonds are doing. The business side is a whole another animal. My father passed in 2008. I was not of age to take over the business. I had to reset my career. Happened to be the same year that Lehman Brothers happened. Happened to be the same year I got my CFA charter. Had a brief stint at a family office. And this is, as the whole world is still reeling from the great financial crisis. Ended up leaving the family office, working for another investment advisory firm, launching a mutual fund, arguably at the wrong time, which maybe we can touch on a little bit later. And ended up just writing a lot. Started writing for guys like Mark Faber of the Gloom, Boom, and Doom Report, Barry Ritholtz of the Big Picture, John Malden, started getting in the media, started writing for MarketWatch, all while managing the mutual fund I launched in 2012. And long story short, built a fairly sizable social media following. Have quite a few research papers out there that won different awards. And still the struggling entrepreneur, for lack of a better way of saying it.
Well, I want to touch on a tweet you made recently that I found fascinating. You said, they complain about how China can just take assets and do whatever they want with the wealth of their citizens, as the US does the same through inflation and monetary manipulation. Now, for those well-versed in this area, they know exactly what you're talking about. But for maybe those who are a little bit newer to the concept, could you explain how the US and many other nations covertly siphon wealth through inflation and monetary manipulation?
So to be clear, I'm not like an anti-Fed type of personality, even though some people may think that based on reading posts like that. But I do think it's very clear that taxation is a form of theft. And by the way, it's a theft we agree to. I mean, it's part of the contract that we have with our governments, right? In response to using public transportation, using public works and services. So inflation is also a theft. Okay. And to the extent that the powers that be want to concentrate power further, what do? They basically create policies that inherently only benefit a select number of individuals and institutions. Inflation rises as that occurs, and all that ends up resulting in the net value of most people's assets going down after inflation, whether it's an actual piece of property or it's an income stream, whatever it would be. The whole point of that post is it's just kind of comical to me that you have this narrative, which, by the way, is valid, that there's no real property rights in China because they can do whatever they want and take it away. Meanwhile, by the way, you have eminent domain in the U.S. And you have policies which clearly have been inflationary, benefiting, again, a select number of people, and everyone else getting screwed by the inflation that comes with it, which it does erode their property. So just because you don't have a government that's outright physically taking what you own that's worth something, and instead is inflation eroding that away, it doesn't mean they're not still taking it. Right? I think that's sort of the point. Now, what do you do about it? It's a whole other dynamic. I mean, the reality is everyone's forced to take risk. And the problem, of course, there is that if you're forced to take risk, you might be able to counter the effects of the government taking your assets through inflation. You also might lose more.
Right. Now, I know you're of the mind that we will not see a soft landing. I mean, the whole soft landing versus hard landing debate is kind of ridiculous. I don't see it as so black and white, but you do see turbulence up ahead for markets and the economy. We're seeing the long dated treasury market currently tanking. And you recently tweeted, phase one of the credit event continues in treasuries. Phase two of the credit event is beginning in corporate credit. I will not relent. We are in a very dangerous dynamic now, just as everyone got bulled up again. Could you break that down for us?
Yeah, and listen, I will preface this by saying I have been early/wrong, because it's easy to confuse the two, right? In arguing that the flight to safety dynamic in treasuries kicks back in. Now, let's take a step back for a second. People say treasuries are a hedge, and they think it means they're a hedge to the stock market. Okay. What treasuries are a hedge to is rising default risk in corporate credit. Treasuries are a hedge to credit spreads widening. Now, what does that mean? It means at some point when there's concern of a recession or concern about the economy, those that are lending capital to highly levered issuers, they say, you know what? There's a risk that I may not get my money back. So I need a higher rate of return for that risk. I need to be compensated for the risk that you, as the borrower, are not going to fully pay me back on what I'm lending you. So that's a default risk premium. So when the market starts to worry about defaults, those premiums will increase. Junk debt starts yielding more because now there's higher risk in lending that money to those highly levered issuers. And as that's happening, that tends to coincide with money saying, you know what, this is a little too risky. Let me go up the quality scale. Let me go to higher quality assets, higher quality debt issuers, ultimately to the U.S. government, because the U.S. government can't default because it's got a printing press. So the flight to safety dynamic, the idea of treasuries are a hedge, it's not that they're hedged to stocks, they're hedged to credit spreads. Now, when credit spreads widen, stocks also fall, right? I mean, that's sort of the link there. So they confuse the mechanism of treasuries as a hedge to the stock market when it's really the credit spreads, which then goes to the stock market. Now, so I've been early and wrong in arguing that treasuries will get back to that flight to safety dynamic because credit spreads have stayed, to most people's surprise, unbelievably tight, despite the fastest rate hike cycle in history. Default risk has not increased in the public bond markets. This despite the inverted yield curve uninverting, which typically happens right as the recession is about to hit. And this, by the way, as there's a lot of zombie companies, especially in small caps, which likely are not going to survive, rolling over their debt into higher rates. End of August 25th, I said, you know what? Treasuries could be up something like 25%, because I was expecting, sometime in October, given the intermarket work I do, potential for conditions favoring a credit event. September 1st, I saw what was happening. I said to myself, well, maybe I'm actually wrong on this. Maybe actually treasuries are the credit event. And then you saw this very aggressive spike in what seems like treasuries, the most important asset in the world, basically trading like an insane cryptocurrency, okay, in terms of the speed and volatility. That does not change my view that we're still on the verge of a corporate credit event, because at some point, what's happened to treasuries should filter through to companies, because again, the government steals our money through taxation, which means they're going to put higher default risk at some point on companies to pay off their debts by taxing those other borrowers more at some point, right? They own us, the government. So from that perspective, phase two of the credit event, which I think we are in, would be credit spreads widening. Now, that is starting to take place. So what's interesting to me about the sentiment around the fourth quarter ramp up, melt up, and this run higher despite war between Israel and Palestine, is that credit spreads are actually starting to widen now. So the nature of this comeback is different. Now, maybe it doesn't persist, maybe it doesn't blow out, but this is typically how credit spread widening works. It happens very slowly and very aggressively, very suddenly. You're not supposed to be able to have time to position for it. If I'm right about the corporate credit side, that then brings back the flight to safety trade and treasuries, which I go back to was always the missing ingredient. Final thing I'll say on this is I am in some ways hoping for this, because the reality is I launched 3 funds, which are rules-based, which run the exact same way if I die tomorrow. So, and they all rely on treasuries. They all rely on the flight to safety trade. So the last 2.5 years have been brutal. I could see that treasuries were failing, and you can't really do anything about it because that's what a prospectus is telling you the funds do. So I am partially, full disclosure, kind of hoping that that happens, because it gives me a chance for my own funds to come back out of that nasty drawdown that they are still in. That's not to say that I'm a perma bear. That's not to say that stocks would stay down. It's just to say that normalization kicks in. Default risk creeps back into the bond market. And suddenly people realize that the market is not just 7 stocks.
And you mentioned an inverted yield curve there. So I'd like to just take a step back, and maybe if you could explain what that means and its correlation to recessions, why when an inverted yield curve starts to normalize, that can generally signal that a recession is up ahead.
Yeah, the yield curve is an important indicator for potential recession. It's not a guarantee, right? No signal is a guarantee with this type of world that we're in. But it's typically a signal of a recession because it suggests that the demand for money is falling further out in time. And that's why yields are lower on the long end versus on the short end. Okay, that's why credit contraction tends to happen, because there's no incentive to lend long if your rates on a longer time frame are lower than your current rates, right? That's now on the uninversion. That typically also as a, it's on the uninversion when you tend to have the recessions typically occur. Why? Because again, the yield curve is a forward-looking mechanism saying that, you know what, we're going to have a recession, and then coming out of a recession, growth and inflation would rise over time. So there's a cycle aspect to those yields rising the long end, which creates the uninversion and then the steepening, right? So again, it's not foolproof. Japan has had plenty of recessions, without that dynamic necessarily being there. But typically, it is a warning sign. It's a condition that suggests, it's raining and you might want to be careful. If the yield curve is right, or at least the uninversion is right about the recession, you would expect credit spreads should widen. You would expect default risk to rise in the corporate credit side of things, because what do recessions do? They cause bankruptcies. They cause restructuring. They cause fear. They cause volatility. Right? They cause cleansing, at least to some extent. So I think it's actually really interesting here that, again, everyone is getting bulled up. We have not taken out the prior highs on the S&P or the NASDAQ. We are nowhere near the prior highs, certainly after inflation, when it comes to small caps, retailers, Europe, emerging markets from 2021. What's to say you can't have a recession next year and still be in the same old bear market? Because I have to tell you, for all these narratives around the new bull market, these people are just, I'm sorry, they're out of their minds. All the other dynamics of the market are clearly screaming we are in a bear market still. It's just we got sucked into this AI melt-up concentration dynamic that's driving the S&P and the NASDAQ. The NASDAQ, which everyone's like, oh, it's so close to the prior all-time highs, and yet only 25% of the stocks in the NASDAQ are above their respective 200-day moving averages. It doesn't make sense.
You have also said that you think the Fed will panic and lower rates this year, just like 1987. Why do you think they will be forced to pivot? And are there any parallels you could draw between now and 1987?
I think they could be forced to pivot if you have a very sharp credit spread widening type of dynamic, which is a VIX spike, which is a crash. Doesn't have to play out exactly like 1987, but typically, there's a reason why there's that expression of staircase up, elevator down, right? And if I'm right that we're in the credit event, and phase 2 of the credit event is the corporate credit event, and that starts with this widening that's happening at the margin, it can get out of control very quickly. If it gets out of control very quickly, the Fed, I don't think would actually pivot necessarily in terms of rates. They might pivot first in terms of the balance sheet, right? Because I do think that even if you have a massive sudden dislocation, whether it's sparked by Japan or China or something domestically here in the US, either way, they don't want to be seen as being whipsawed around short rates, but they can certainly still play with the balance sheet. So, a little caveat, I think, on that end. But the Fed always does what it does in terms of acting with a lag, also, meaning they respond to a crisis after the crisis. So it's not that I'm trying to be a perma bear by any means. I mean, anybody that's looked at my research and my work sees that I'm clearly not wedded to any particular longer term viewpoint. But history would suggest that if you have a credit event, the Fed steps in. They'll step in too late. The credit event and the pain would still have taken place. But yeah, to think that the Fed can't pivot just because we're this late in the year, it happened in 1987. What's to say it can't happen again?
And is now a time to own gold in your view? And in your opinion, in what sort of market environment does gold typically outperform the broad market?
If I'm right that we're still in a bear market, which again, I would challenge anybody on it just looking at very basic charts outside of the S&P and NASDAQ. If you start turning lower and spreads start to widen meaningfully here, which again, I think we're still very early on, but I think it has started. The bigger institutional players will probably say, you know what, maybe we need to diversify. Right? Now, from that perspective, there aren't that many real diversifiers from a portfolio construction perspective. Right? The S&P 500 is not diversified. The Russell 2000 is not diversified because they're still asset class specific, and they still largely correlate to each other, even though this year has been very abnormal in the disconnect of large to small. So what do? They probably say, you know what, I need some non-correlation. Now, gold is the ultimate non-correlated asset. By the way, not correlated to anything. All these narratives around gold is correlated to dollar, to stocks, to bonds, maybe in momentary rolling periods, but for the most part, gold doesn't really correlate to anything, which makes it a diversifier, right? Because the very idea of diversification is around correlation. So if I'm right about a credit event, if we are still in a bear market, probably some of these larger players start to say, you know what, we need to diversify. So what do? Let's maybe go into gold. Let's up our gold allocation from nothing to 2%, 3%. Let's up our 3% allocation of 4 or 5 at the margin. Now, if you get enough big players doing that, that sparks, I think, a self-fulfilling momentum cycle. By the way, as gold is still not that far off from the prior peaks. Right? And I think that if that ends up getting overtaken, which I think is possible, because again, as a diversifier, gold does tend to also act like a risk-off safe haven trade for a moment in time. I would expect gold to do well in a flight to safety sequence, which we could be on the verge of as spreads widen. And it then makes sense, right, for that momentum trade to really finally work after years of frustration. That's not so. So going back to your original question, would I consider buying gold or not? What I would say is I would consider gold working if people start thinking that correlation is not working, and I think we're getting close to that.
Your Twitter profile picture shows you with lumber and gold eyes, a play on the Bitcoin maxi laser eyes, which I think is really cool. And you also wrote a paper called Lumber Worth Its Weight in Gold, Offense and Defense in Active Portfolio Management. Could you break down that paper for us and explain if there's a correlation between lumber and gold that people should be paying attention to?
Right. So it's deceptively simple. Lumber is a play on housing. Housing is a big driver of economic growth activity, credit expansion, risk-on dynamics. Right? Lumber is highly correlated to housing starts. I am blown away how people don't really understand that. And yet they live in houses which would not be up there unless you had framing from lumber. Okay. Gold is, again, a risk-off safe haven. So you compare lumber's performance to gold's, and that tells you, on a go-forward basis, the likelihood of risk-on happening or risk-off. Risk-on being lower volatility dynamics for risk assets. Risk-off being higher volatility dynamics for risk assets. Not based on my opinion, based on historical back-tested fact. Okay? Now, I have to tell you, this is another thing that drives me crazy. Lumber to gold is a signal. But what is the look-back period? Okay, so what do I mean by that? Okay, well, moving average is a signal for the stock market, right? But the conclusion of whether you're above a moving average or below moving average is a function of what look back period are you looking at? Are you looking at a 200-day moving average, a 50-day moving average, a 10.5-day moving average? Because depending on the look back period with the exact same signal, you get very different results. Right? It's like people forget there's a time aspect to looking at signals in terms of how far back you're looking for your trigger. In the paper looks at rolling 13 weeks. Why? Because, wanted to make it something that would probably not have as much turnover as obviously a shorter term time frame. My Roto ETF, which uses the same lumber to gold concept but uses a much shorter time frame, right, is trying to more tactically short term position offense or defense based on that lumber to gold relationship. Now, where we are now is interesting. Home builders have turned around pretty aggressively. Right? There was a huge disconnect between lumber prices and lumber prices going down and lumber price and home builder stocks rising. Right? Now they're actually confirming each other. Maybe it's nothing, maybe it's something. But the fact that home builder stocks are weakening, and by the way, lumber to gold is also now weakening, suggesting risk off is imminent, right, is intriguing to me around the corporate credit event thesis. That you're getting some kind of confirmation in these two important parts of the marketplace. So bottom line is it's not some magic relationship. There's a causation. Lumber is tied to housing. Gold is tied to risk-off safe haven behavior. You compare the two to each other. It tells you something about risk-on, risk-off volatility dynamics going forward. Not based on my opinion, based on fact. But if you're going to use it as a signal, you have to figure out which look-back period you want to look at to determine when to play offense and when to play defense.
I'd like to get your long-term outlook on the energy market here. We're seeing some interesting catalysts, U.S. shale production in decline, OPEC cuts extending into next year. Obviously, we have the potential short-term effects of the Israel-Hamas conflict if Iran gets involved. Lindsey Graham talking about bombing Iran. Let's hope that doesn't happen. But
he's
nonetheless,
he's an idiot.
Yes.
Sorry, they're all idiots, but don't get me started.
Yeah, I completely agree. But nonetheless, if Iran's obviously oil supply was threatened, that could also spike the price of oil. That's more of a short-term catalyst. I'm wondering what you see if we're looking out over the next 5 years, even into a decade when it comes to oil and gas.
So I do agree that the nature of oil gas is that it tends to have, tails in terms of, spikes higher in price. You're more likely to have a spike higher in oil and gas than you are to have a crash in oil and gas. Just, in terms of the where you are on the distribution curve historically. Whereas with stocks, you're more likely to have a crash downwards than a spike up, right? There's a different dynamic there. Okay, so I'm very much on board with the idea that the oil and gas space is underinvestment, right? The supply is probably going to be tight for a while, and that, it's vulnerable and susceptible to shocks higher. That doesn't mean that in the short term you can't have some real lower prices. What does a credit event do? It breaks consumer spending. It makes everyone afraid of recession. It makes the stock market go down. It makes fear refreshed in risk assets. It causes a pullback in demand, which then, despite relatively tight supply, would impact anything energy related. So the argument that energy would be, and oil and gas would be isolated from severe consumer slowdowns, to me doesn't make sense. Some will argue, well, what about the 1970s? I've never bought the stagflation argument personally. I don't believe you can have stagflation. I don't believe the system can work like it did in the 70s when you have 34 trillion or whatever the hell the number is now in government debt. Stagflation doesn't work when your starting point for stagflation is extraordinary debt. It's either going to be hyperinflation or outright default deflation. There's no in between. So I think in the short term, it's more likely that oil and gas weakens. And that's consistent with the corporate credit phase 2 event type of dynamic. Longer term, though, yeah, I do think the bias is probably higher. That doesn't mean that you necessarily buy oil ETFs or buy gas ETFs, but it doesn't mean you probably want to overweight energy stocks in a portfolio. Yeah, I think that makes sense. Certainly more so than tech on a relative basis.
And same time frame, if we're looking out over the next 5 years, are there any other commodities that you think could perform well over that time frame?
I think in general, it will be interesting to see what China does on a go-forward basis, right? So we know their property markets are imploding now, but maybe they end up trying to reflate it and reinflate it in the years ahead. I do believe in general there's a lot of interesting research around how infrastructure is crumbling, not just in the US, but worldwide. So we will need to go through a renaissance of rebuilding, right? Which means that anything related to industrial commodities, right, construction materials, from a longer term perspective, should get a bid because we have to rebuild a lot of the infrastructure globally. But no, I think the obvious ones really are going to be oil in particular, and gold. Just again going back to the diversifier arguments, look, you've had over a decade of lost performance in gold and commodities in general. That sounds like a buy.
And could you maybe give us some insight into where you're personally allocating capital at this point in time? And if you wanted to touch on your suite of ETFs, that would be great as well.
This goes back to the start of the conversation. The business side is a very different dynamic than here's a couple of squiggle lines and I'm trading from my basement, right? And I know where NVIDIA is going to go. I'm an entrepreneur. I launched 3 funds. They're all risk on, risk off. They all rely on treasuries. They all follow different signals. So they're not necessarily going to be correlated, but typically when you're in a risk-off event, all of the signals, all of the funds, ATAX, Roro, and JoJo would be in the exact same position. We're getting close to that, which is why I'm not relenting on the idea that we might be on the verge of that corporate credit event I argued was coming towards the end of the year back in January. So as an entrepreneur, when you bring funds to market, funds are an expensive endeavor. To bring a fund to market is not like some cheap dynamic, right? I mean, I'm somebody who does have skin in the game because it costs about $250,000 to bring a fund to market in the first year, assuming you had $0 in assets. Right? I mean, these are businesses, right? So, as is the case with any entrepreneur, you've got to be all in with what you believe in. Now, in the case of the fund world, you are much more beholden to cycles than your own views on markets, right? Every fund has a cycle that favors it. A cycle of pure risk on, pure large cap momentum sucks for my world because I get whipsawed around the risk on side, which is not necessarily large caps, and risk off, which is treasuries, which again, I have not worked. So I'm giving you a long-winded answer because there's a lot of nuances to it. In terms of where I'm invested in myself. I'm invested in my own businesses. I believe that the cycle will come the way of my approach again because I have data on my side and I don't have the time frame of a flea when it comes to evaluating a strategy in a very abnormal cycle. For those that don't have their own businesses or portfolios, what I would say broadly is you're much more likely to avoid a drawdown in anything after a drawdown's already taken place. Like, that should be obvious. I'm pretty sure we just went through the biggest drawdown in history for bonds and in particular treasuries. By the way, the drawdown from bonds will likely continue because a corporate credit event means junk debt collapses. Right? Spreads widen, so meaning the drawdown for corporate credit is still probably yet to fully finish, but the drawdown in treasuries, I mean, yeah, maybe yields do keep on rising, but I fail to understand why people don't understand that blood in the streets that you're supposed to buy when there's blood in the streets doesn't apply to bonds or to treasuries in particular, to duration after what we just went through. So to a large extent, I think if you're going to invest, best thing to do is invest in yourself, invest in what you believe in. If you're going to be an entrepreneur, if you're not following that type of an approach to your life, diversify the hell out of your portfolio. Don't be overly convinced. And the last thing you want to do is take on longer term leverage because markets have a funny way of putting us all in margin calls.
Well, thank you so much for joining us today, Michael. It's been a very enlightening conversation. Where can people find out more about your suite of ETFs? And if you could tell us about the lead lag report and where people could find that too, that'd be great.
Yeah, sure. So it's atacfunds.com. Full disclosure, the performance has not been good at all for all the funds. And again, attribution-wise, it's not because of the signals. It's because of the opportunity set. Because the cycle has been so brutal towards small caps, towards emerging markets, towards treasuries. unless you believe the world is going to be dominated by large caps forever, strategies like what I do have, I think, a place in a portfolio. Otherwise, I wouldn't have launched them to begin with. The lead lag report is a totally separate effort, right? Separate business, totally separate type of dynamic than rules-based funds that I brought to market. But at lead lag report on X, on Threads, on Instagram, on YouTube, all that good stuff, that's sort of my content persona research. I do find it interesting. People really do have a hard time differentiating between me as a portfolio manager running funds to mandate, and then me as a thought leader and this kind of loud persona when the funds can run without me. The research, that's me. That thought process and everything that people see on social media, that's sort of the inner workings of the way that I think about markets. Obviously, they are related to some extent because it's still ultimately my thinking. Just one's codified explicitly in the funds, one is not. But everything I do is still ultimately, regardless of anything, based on research, backtesting. That doesn't mean that I'm going to be right or wrong. It just means that I have a reason, whereas most people don't.
Great. Well, I'll put links to all that in the description below for people who want to check it out. And really appreciate you once again, Michael, coming on and sharing your knowledge with our audience.
And I appreciate your patience. Those who are watching and listening to this, make sure you subscribe because we had to push this out a little bit, given some technical difficulties on my end.
Oh, no problem. Technical difficulties are par for the course. Thanks once again, Michael, and you have a great day.
Everything was glitching, my friend. Everything was glitching.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.